back to Crystal Ball. I have been speaking with Dr. Mark Mobius, the Executive Chairman of the Templeton Group of Funds. Dr. Mobius, let me now shift gaze to China. You have been saying that, you are noticing Chinese stock markets give you some fairly rapid returns. Do you think that you might see fund managers preferring China to India in, say, in the next couple of months?
I think the fund managers have a certain allocation they want to use for China and a certain allocation they want to use for India. There'll be differences as a result of price changes and opportunities taken to sell or to buy as a result of price fluctuations. But generally speaking, I think managers have a certain allocation they'd like to put in India, and they're just waiting for the opportunity, unless they've already done so.
Okay. I'm asking you because there is a lot of India versus China discussion. But the latest reserve requirement cut in China has not been interpreted by everyone as positive and as an entry point. There are some who worry that perhaps the Chinese economic growth is under greater threat than they have assessed so far. How would you look at the reserve requirement cut that recently came, the unexpected one? Do you think economic growth is a spot of bother in China?
There's no question that growth rate is slowing in China. We've already seen it. They've gone from 10% to now 7% and probably going to be 6% this year. But you must remember the size of the economy has grown so rapidly that 6% in dollar terms, in terms of an increase to the economy, is much greater than 10% was 5 years ago. So I think people tend to lose sight of the fact that the dollars are much, much greater now in China moving into the market. And you must remember also that the Chinese government is using the stock market as a policy measure to put more money into the hands of consumers, because they realize they've got to increase spending and expand the consumer market. And by pushing up the stock market, they can do so. So it's more of a policy measure, whereas in India it's the opposite. The government is not using the stock market as a policy instrument, let's put it that way.
Okay. Well, generally, over the next 12 months, what's your sense in terms of what smart money in the world might chase? Will they prefer developed markets, Europe and the United States, or will money incrementally start looking at emerging markets after the severe badgering they got in the last 6 to 8 months?
There's no question that there's going to be a movement into the emerging markets. But you must remember, for the last 2 years, emerging markets have underperformed the U.S. and the world markets. This year, since January, emerging markets are outperforming. And when you see that, of course, it attracts investors. So they want to be in places that are moving up and are outperforming. So I expect you'll see more and more money going into emerging markets.
Well, one of the things, other than Mr. Modi, that went right for India is the fall in global commodity prices. How do you see global commodities, not just crude, but crude and other, say, base metals, progress over the next 12 to 24 months? Is the bear cycle likely to continue?
Yeah, you'll probably see a recovery in prices in commodities generally. You must remember that not all commodities have gone down. You've got commodities like palladium they've maintained and actually moved up. So generally speaking, you're going to find that the commodity prices have bottomed, let's put it that way, and now will begin to inch up. It won't be a rapid rise, but they'll begin to move up gradually.
In your assessment, has crude bottomed? I mean, crude went to $45 and below and is now well over $55. You think we have seen the bottom for crude prices?
Yes, I think we've seen the bottom. We'll see some fluctuations around these prices, but I think now we're on the way up again. Simply because, the U.S. has been sort of the swing producer with a very small percent of the global production. With the rig count in the U.S. come down dramatically, production will come down as well. And therefore, the pressure that you've had from shale oil will begin to diminish in the global market.
Well, there are two more global questions that I must ask you, Dr. Mobius. The Greek issue. How key or difficult is going to be the Greek exit issue. Do you think there is an exit at all, or will that be averted? If that were to come, would it be seriously disruptive?
Well, for the last almost 3 years now, I've been saying Greece will not leave the euro, will not leave the European Union. They are part of Europe, and it would be a real disaster if they ever left. And everyone realizes that, particularly members of the European Union. We must remember, this is not a financial issue anymore. It's a military issue. Greece is part of NATO.
Yes.
And a very important part, a strategic part of NATO. You can't have a member of the NATO leaving the European Union and leaving the euro and resulting in some very different situation politically and very chaotic situation.
Absolutely.
You could have Russians being invited in. You could have general chaos.
Yes.
So strategically, it does not make sense. And that's the reason why I don't think Greece will be allowed to leave the euro and leave the European Union. And by the way, the Greek people don't want it as well.
Okay. Well, that's settled. The other big global event that keeps coming onto our radar every now and then is the Fed rate hike. According to you, will we see a hike this year at all, considering the kind of soft data we're getting from the United States? If we do, how should an emerging market investor look at it? How worried should they be?
Well, first of all, if you look at all of the commentary that's been taking place all this year, everyone expects the rate hike.
Yes.
So it's in the market already. So if it happens today, if it happens at the end of the year, probably not going to have a big impact. Maybe in for a day or two there'll be some impact, but it won't be significant. The question is whether they will actually do it. And the reason for having a rate hike is inflation. Where is the inflation? If inflation is not there, it's very difficult to justify a rate hike, particularly when the U.S. dollar is getting stronger against other currencies. That is a very, very difficult situation for the U.S. The U.S. dollar strength is making a lot of exports uncompetitive. So you have a situation where a rate hike in the U.S. and money printing in Europe, Japan, and China. There's a complete disconnect between central banks globally. So I think it's going to be very difficult for the Fed to make a dramatic move in terms of rate hikes. There may be at the end of the year some token increase, but it's very difficult for them to justify that.
Okay. So you don't see it dramatically altering the flow of funds, nothing that might disrupt flow of funds to emerging markets, any serious outflow that might result in a run on any currency. I mean, how would the rupee itself fare, you think?
No, I don't think so. At least in the equity space, because what's happened is that the U.S. market has run up to a very high point now, making it more expensive than other markets around the world, particularly emerging markets. So I think the flows out will continue.
The flows out of the United States and into emerging markets, you think?
Yes.
All right. In spite of a rate hike happening.
Yeah. Now, of course, if you have a dramatic rate hike, 1 or 2%, then there you've got a complete changing situation. But I don't see that happening.
All right. Dr. Mark Mobius, it was a pleasure speaking with you. Thank you very much for joining us and giving us your perspective on a range of
Thank you very much.
Thank you.